What are the most important advances in trading you have seen?
First off, electronic trading. So like I said, when I got there, it was, 4,000 people did 80% of the volume. Now there's 200 that do 15 or 20%. That's technological disruption. And electronic trading destroyed that business, what we call open outcry model. But I'm not overly nostalgic. I'm glad that I saw the NYSE at its very height. It really was something to see. I mean, it's mind-boggling what a spectacle it was. Electronic trading was a more efficient way of transacting. It dramatically increased trading volumes. The times to confirmation collapsed dramatically in sub-second intervals. So by and large, I thought that was a great development. Decimalization, same thing. We were trading in eighths when I was here. And in 97, it went to sixteenths. Excuse me. And then in 2000, it went to pennies. Also dramatically reduced the costs of trading. So birth of electronic trading and decimalization would be one. I would say passive investing in exchange traded funds. I'm a Jack Bogle disciple. Bogle argued for decades that individuals should not try to beat the market. They should stay with the market. He created the first investable S&P 500 products in the mid-70s. Vanguard eventually became a legendary investing house on him, and I totally bought into that. By the mid-90s, I could see that was the best thing to do. Don't try to time the markets. Stay with the markets. Stay in low cost. You spend too much for active management. It eats into your return. The third thing I would say would be behavioral finance. We used to honestly believe that people made rational investing decisions. This is the so-called homo economicus, the person who always buys lows and sells high. And what we discovered and have discovered is people don't do that. They don't buy low and sell high. They buy high and sell low. Why do they do that? Why do they act irrationally? And John, you're a student of this. The really broad studies began in the 1980s to show why people behave irrationally, to demonstrate essentially that there are enormous amounts of biases that people have, which now have fancy labels that explain irrational behaviors, some of which can go back to evolutionary things.
What advice do you have for older investors?
Bogle's essential precepts from 50 years ago are still correct. 3 out of 4 years, the S&P goes up. Most of the time, it goes up 10% or more. However, there are years where it happens, but big down years are very rare. Like 2022, that wasn't 20%, but it was 18 or 19%. And there's only been 7, 8 times where you've had declines of 20% or more in the last 100 years. And they tend to bounce back 2/3 of the time. Usually you're made whole within a year or two. So the nature of the stock market tends to self-correct after a while. Other than stay with the market and don't get freaked out about down years, just keep a long view. Like I said, the second thing that's very important is pay attention to medical technology. You're going to live a lot longer than you think. The actuarial tables are all wrong. I'm almost 70. I used to assume I was going to live to 80 to 85. I now know that's wrong. The fact that I've now made it to almost 70 implies actuarially I have a very good chance of living to 90. And in fact, I have friends of mine who insist that I'm wrong on this, that I should play for 95. This has very important implications for whether or not you're going to outlive your money. So think about this. I mean, if you're 30 years old, you're going to be around 60 years as an investor. Most people who live over 65 are going to make it to 90. So this implies that somebody who's going to retire at 65 or even 70 is going to have 20 more years of investing. Well, this is not good if you believe in a 60-40 portfolio. That is way underweight in stock market, I think. This is my personal opinion. I think most people would look at a long view would agree with that. So to me, this implies that you could take a lot more risk than you could think. And I'll tell you another thing, just not just living longer. People don't think of their investments properly. When they say 60-40, people are usually thinking about how much money do they have that's investable in their 401k or in their mutual funds. But people don't look at things like Social Security. Social Security is an annuity. It's a bond-like product. So that should count as a bond to me. Real estate, I don't think that's I don't know if that's like a bond-like product. It's not throwing off any income, but that's a separate investment vehicle that you have. So you can take, if you stop looking at 60-40 in terms of your net investment, your 401k and your mutual funds, and look at it in terms of your overall net worth, that would include cash, include stuff you own at home, include your hobbies, your coin collection, include your real estate, include your social security checks, include your pension check. That's another bond annuity. You could take a lot more risk than you actually think that you do.
What is your biggest obsession in the market?
The first thing you'll notice is, why is everybody so wrong all the time? Why does everybody suck at predicting the future? If you look at the stock market and the prognosticators, we make fun of retail investors. They like to call them dumb money. I find that offensive, but I don't know if it's inaccurate, retail investors. But professional investors have a terrible track record. I have been tracking S&P's 500 SPIVA report, which looks at professional fund managers for over a decade. 90% of fund managers underperform their benchmark over 10 years. 90%. You'd be better off in an index fund than hiring a fund manager. 90% of the time. That's amazing. Not only them, Wall Street has a terrible record. You think all these famous people we hire who come on from Morgan Stanley and JP Morgan and chief market strategists, you think they have great track records? No. That's why they turn over so much. How about all these analysts that hire to cover Caterpillar or IBM? Terrible track records. The Federal Reserve itself, the smartest people out there, has a terrible track record. Jay Powell admitted that they have a terrible track record predicting inflation 1 year out. Powell has said, we have a lot to be humble about. Well, how is this possible? How is it everybody is wrong about this? This used to make me nuts, because by 1999, I had been around for 9 years, and it was obvious to me, and I had this quest. There's a whole chapter in the book about this. I call it The Search for the Wizard of Oz, the perfect trader who knew everything, the perfect trader who had access to all information and was never wrong. It turned out this is a lot of hooey. And there's a reason for this. There's several chapters in the book about this if you're really interested, but there's two fundamental problems. The first is the future is ultimately unknowable because of the amount of information that goes into the computations. It's kind of like predicting the weather a month out. So imagine this, you're a Caterpillar analyst. So your job is to predict Caterpillar's earnings 1 year from now and give an estimated price of where Caterpillar is going to be. That's what these guys do. You think, how hard this could be? Is it just Caterpillar? It's one company. How hard could it be? It turns out it's really hard. These guys are terrible. And the reason is because there is so much data that goes into determining what the bottom line earnings number is and the price. So think of the things that can go wrong. Think of the macro stuff. The macro stuff could be the economy tanks, or you have a war, or something directly impacts the company, like another buyout from a big competitor, or something at the top happens. CEOs get ill all the time. They get replaced. Suddenly there's a management change, philosophy changes. That changes the course of the company. Or a product has a major defect. And I'm just listing the obvious ones. There are literally thousands of inputs that can go into this. It's actually a really difficult job. So number one, the amount of inputs that go into making up that number, that earnings number, and the price of that stock is vast and very difficult to figure out. The second problem is the one we talked about earlier on behavioral economics, and that is biases. The analysts, all of us, are infected, literally infected with biases that throw off our thinking. So there's very common biases that we all know about, like overconfidence. You can have overconfidence in your company. You can have overconfidence in yourself. There is mistakes, what's called gambler's fallacy, where you think that you got last month's earnings estimate right, because I'm the Caterpillar guy and I'm the number one guy now of 25 analysts. I'm the one who's been the most consistently right the last 2 quarters. Therefore, I'm going to be consistently right in the next 2 quarters. And that turns out, of course, to be a fallacy. So there's literally dozens of fallacies that they're in my book. I list them, but this is widely studied now. And what happens is if you compound all of these, and you can have more than one bias in your head, you compound these biases, it throws off your thinking from what actually happened. So combine the fact that that there is such a large amount of potential inputs that it's really difficult to figure out. Think of predicting the weather a month from now. And combine that with the biases that you have. This is why people suck at forecasting the future. So you could throw your hands up and say, well, who the hell cares then? Don't do anything. And that is one way to do it. That is the whole basis of basically index investing. I'm not trying to beat the market. I'm just trying to stay with the market. I'm not trying to predict anything. I'm just trying to stay with the overall market. It turns out, and there's a chapter in my book about this, there are ways to get better at predicting the future. There's a guy named Philip Tetlock who runs a project called the Good Judgment Project, where they actually try to train people about these biases and train people to figure out what inputs, what might be more relevant than others. So it's not impossible, John, but most people don't have the training to figure it out or to do it. And once I kind of figured this out, and it took a long time, it took me reading a lot of books and people, explaining stuff to me, I sort of stopped worrying about all of it. And I still cover every year when analysts come out and predict, what their stocks are going to be doing, but I do it very tongue in cheek and always point out, most of these guys are wrong. We do it because human beings like to talk about the future. You can say, this is a lot of baloney, guys. It's not, they're not going to be accurate, but people still want an idea, a base reference point. So you kind of engage in this little game, knowing that it's not going to amount to much because people want it.